So let's review chapters 25 and 26. So this first question says Bosch Company purchased at a cost of $30,000. They purchased and used 6,000 pounds of materials during March. Their standard cost of materials per unit produced is based on 4 pounds per unit at a cost of $6 per pound, and the production in March was 1,400 units. We need to compute the total price and quantity variances for the materials. Before we even deal with the variances, let's just focus on figuring out some of our variables here. So we have actual quantity, actual price, standard quantity, and standard price. So if we find those four, it'll be a lot easier then to figure out our variances. So actual quantity, that's going to be how many pounds of materials did we actually use during the month. Well, that's our 6,000, right? So our actual quantity is 6,000 pounds. Actual price, that's not just the total amount that we spent, right? We spent a total of 30,000, but we want a per pound. So we're going to do 30,000 divided by the 6,000. So we actually spent $5 per pound. Now standard quantity, SQ, this one can be a little bit tricky. What we're going to do here is we're going to take the number of units that we produced, so the 1,400 units, and multiply it by our standard 4 pounds per unit. So what we're doing here is we are saying that if we went into the month expecting to produce 1,400 units, we thought we would use 4 pounds per unit, so we expected to have to use 5,600 pounds. So that's going to be our standard quantity, and then our standard price, that's our $6 per pound. So that's what we would have expected to have to spend per pound of materials. So now that we have all of that, and that will stay up in the upper left corner, now we can compute the total price and quantity variances for materials. So you'll notice I have these three boxes set up. I have AQ times AP, AQ times SP, and SQ times SP. Well, AQ times AP minus AQ times SP, that difference will give you the price variance. Then AQ times SP minus SQ times SP, that difference will give you the quantity variance. And then we can use the price and the quantity variance to find our total variance. So let's start plugging in the numbers that we know. So AQ times AP, that's 6,000 times 5. AQ times SP, that's 6,000 times 6. And SQ times SP is 5,600 times 6. So if you do that math, you'll end up with these values: 30,000, 36,000, and 33,600. So we can use these now to figure out our variances. So we said that the difference between these two, the 30,000 and the 36,000, that's going to be our price variance. So we subtract those two numbers and we get 6,000. Now, a variance is either going to be favorable or unfavorable. And how do we figure that one out? Well, our actual price was less than our standard price. So you went into the month expecting to have to spend $6 a pound, when you actually only had to spend $5 a pound. So that is favorable because you want your costs to be less. So now we take a look over on the other side for our quantity variance. And if we take the 36,000 minus 33,600, we end up with 2,400. So we need to think, is this favorable or unfavorable? Well, we actually used our actual quantity was 6,000 pounds. We expected to only have to use 5,600. So we used more than what we thought we were going to have to. And that makes the quantity variance unfavorable. So now we can use our price and our quantity variance to find our total variance. So our price variance, that was 6,000 favorable. Our quantity variance was 2,400 unfavorable. Since one is favorable and one is unfavorable, we subtract them. If they were both favorable or both unfavorable, we would add them together. But since they're different, we subtract them and we get 3,600. Now this 3,600 is either going to have to be favorable or unfavorable. And we take the sign, the favorable or unfavorable, of whichever one was larger. Right? So we had 6,000 on the favorable side, but only 2,400 that was unfavorable. So our total variance is 3,600 favorable. So now we can take a look at question number 2. Question number 2 is similar to number 1, but instead of using materials, we're now looking at variances for labor. So the question says, McCarthy Company's standard labor cost of producing 1 unit is $3 at the rate of $17 per hour. So those are our standards, right? That's our expectations. And then during April, 42,000 hours of labor are incurred at a cost of $18 per hour to produce 12,000 units. So we have our different variables down in the lower left. It's similar to what we just did with the AQ and SQ and all of that. Here, it's actual hours, actual rate, standard hours, and standard rate. So hours are like quantity and rate is like price. But since we're dealing with labor, we have some different words. So actual hours. How many hours did we actually incur in labor? 42,000. Right? During April, 42,000 hours of labor are incurred. So that's our actual hours. Actual rate, that's our $18 an hour. Standard hours, we take the 12,000 units that we produced and multiply it by the 3 hours that we expected it would take to produce 1 unit. So 12,000 times 3 gives us our 36,000 for our standard hours. And now our standard rate, that's just $17. So now we can use all of these to help us find the total price and quantity variances for labor. So once again, I have these boxes set up, right? Actual hours times actual rate, actual hours times standard rate, and standard hours times standard rate. We are going to use the same concept as we did before. Again, the only thing that's changed is instead of actual quantity, we're now using actual hours. And instead of price, we're using rate. Every other piece is just like when we did this for materials. So we start to plug in our numbers. 42,000 times 18, 42,000 times 17, and 36,000 times 17. So we get 756, 714, and 612. Our price variance will be 756 minus 714. So we get 42,000. So we think about this and say we spent $18 an hour. We thought we'd only have to spend $17 an hour. So since we spent more than what we actually did, or we spent more than what we expected we would have to, it is unfavorable. Now we move over to the quantity variance side. And we take the difference between 714,000 and 612,000. And we get 102,000. So this is dealing with quantity, right? So we expected our standard hours were only 36,000. We actually incurred 42,000 hours of labor. So we had more labor than what we thought we'd have to, so that's also unfavorable. So now we can use our price and our quantity variance to find our total variance. So we have 42,000 unfavorable as our price variance and 102,000 unfavorable for our quantity variance. Like I said earlier, when they're the same sign, right, when they're both unfavorable, we add them together. So our total variance is 144,000 unfavorable. So now question number 3. Question number 3 says Parsons Company manufactures and sells homemade wine and they want to develop a standard cost per gallon. The following are required for the production of a 50-gallon batch. So we have a bunch of different ingredients here. So for 50 gallons of wine, we need 3,000 ounces of grape concentrate, 54 pounds of sugar, 60 lemons, 50 yeast tablets, 50 nutrient tablets, and 2,600 ounces of water. Then it tells us Parsons estimates that 4% of the grape concentrate will be wasted, 10% of the sugar is lost, and 25% of the lemons cannot be used. We need to compute the standard cost of the ingredients for 1 gallon of wine. So I would recommend taking a picture of the screen right now, so that way you can reference back to it as we prepare our table that we're going to make to try and figure out the standard cost. So what we're doing is we're taking the recipe for a 50-gallon batch of wine, and we're trying to figure out, okay, what could we expect 1 gallon of wine to cost? So how are we going to do this? Well, we make this table. So we need to list out all of our ingredients. So we have grape concentrate, sugar, lemons, yeast, nutrient tablets, and water. The next column is how much of each ingredient are you going to need in a 50-gallon batch, right? So these are the numbers that were given to us. The 3,000 ounces, 54 pounds, 60 lemons, right? Those were the numbers given to us originally. But we want to know the standard cost for 1 gallon. So, step number 1 to get there is to figure out how much of each ingredient would go into 1 gallon of wine. So if 3,000 ounces are in 50 gallons, if we divide that 3,000 by 50, that'll tell us how much would go into 1 gallon, right? So 3,000 divided by 50 equals 60 ounces. So we would need 60 ounces of grape concentrate in 1 gallon of wine. So we're going to do that same step for each ingredient. So 54 pounds of sugar divided by 50 gets you 1.08 pounds. 60 divided by 50 gets you the 1.2 lemons. Yeast and nutrient tablets, we need 1 per gallon. And then 2,600 divided by 50 gets you the 52 ounces of water that you need. So now we have an idea of what would we need to put into 1 gallon for each ingredient. But we're not perfect, right? We're told that 4% of the grape concentrate is wasted, 10% of the sugar is lost, and 25% of the lemons can't be used. So we have this standard waste. Now, there's no waste for yeast, nutrient, or water, so we're good there. So we're going to use this standard waste along with our amount per gallon to figure out standard usage. So let's take a look at grape concentrate first. We're told that there's 4% waste. So to figure out our standard usage for grape concentrate, we need to take 0.96x equals 60. Now, where did we get these numbers from? 60 is the amount per gallon for grape concentrate. So, that's where we get the 60 from. The 0.96, that's 100% minus 4%. Right? So, 0.96 times x needs to equal 60. So we find out that we need 62.5 ounces of grape concentrate to allow for the waste. So we plug that into our table, right? 62.5. That's our standard usage for the grape concentrate. So now we need to figure this out for the sugar and the lemons. So let's focus on just the sugar right now. So there's 10% waste. So that's 0.9x equals 1.08. So you would need 1.2 pounds of sugar per gallon. Now for the lemons, it's 25% waste. So that's 0.75x equals 1.2 because there's 1.2 lemons per gallon. So we need to solve for x, and that's going to be 1.6 lemons. So now we can plug those numbers into our table. Right? So you'll notice you need to add a little bit more grape concentrate, a little bit more sugar, and a little bit more lemons to help cover up the waste or the loss that you're having with these ingredients. Now for yeast, nutrient, and water.
If it's standard waste, if it's standard waste, why are you taking why are you adding the waste instead of subtracting it?
Well, because we still need 1.2 lemons in every single gallon. So to cover up that 25% waste, we need to add more lemons. So
you do 1.2 divided by 75%?
Right. So you would do the 1.2 divided by the 0.75 for the lemons.
Thanks.
So that's going to find our standard usage. Now for yeast, nutrient, and water, there's no waste, right? So the 1 yeast tablet, the 1 nutrient tablet, and the 52 ounces of water, that all continues on into our standard usage column. So once you've found the standard usage part, the rest isn't too bad, right? The next column is standard price. Those were all given to you. Those were given to you at the very beginning of the problem. We were told grape concentrate is 6 cents per ounce. Sugar is 30 cents a pound. Lemons, 60 cents each, right? We were given all of these standard prices. So we just fill that part into the table. Then our standard cost per gallon. How do we find this? Well, we take the standard usage and we multiply it by the standard price. Right? So for grape concentrate, 62.5 ounces times the $0.06 per ounce, or the 6 cents per ounce. And we see that for 1 gallon of wine, we're going to spend $3.75 just on the grape concentrate. So now we continue this on, and 1.2 pounds of sugar at 30 cents a pound is 36 cents. 1.6 lemons at 60 cents each is 96 cents. All right, so we continue that down all the way through each and every ingredient. So then our standard cost for 1 gallon of wine is just going to be the sum of that last column, right? So 3.75 plus 0.36. We add up all of those amounts, and we can see that the standard cost for 1 gallon of wine is $5.78. So you could expect that 1 gallon of wine will cost you $5.78. However, prices are constantly changing, right? The price for a lemon might not always be 60 cents each. So that's how your actual prices aren't always the same as your standards, right? So if one ingredient, if the price for one ingredient increases or decreases, that's going to change your actual costs versus the standard cost that you just found. So let's move on to question number 4. So this one says Thompson Industries incurs unit costs of $8, which are $5 in variable and $3 in fixed, in making an assembly part for its finished product. A supplier offers to make 10,000 of the assembly parts at $6 per unit. So if we accept that offer and buy from this supplier, Thompson Industries will save all variable costs, but no fixed costs. So we need to prepare an analysis showing the total cost saving, if there's any, for Thompson Industries that they would realize by buying the part. Then we need to make the decision. Should they buy the part, or should they continue manufacturing it? So we're going to set up a table like this. And let's first just focus on the make column. So if we were to make these 10,000 parts, what would our cost be? Well, we have $5 of variable costs per unit and $3 of fixed. So 5 times the 10,000 units and 3 times the 10,000 units give us our variable and fixed manufacturing costs. Now, purchase price. If we were to make the product, we would not be buying the product, right? So our purchase price for the make column is 0. So our total annual cost is just 50,000 plus 30,000 to get us that 80,000. So we would have a cost of 80,000 if we were to make the product. Now, what if we were to buy it? Well, they told us that if we bought the product, we would save all of our variable costs. So, we don't have any variable manufacturing costs if we were to buy it. However, we still have our fixed costs, right? We don't save any of those. So we still have all 30,000 in our fixed cost for the buy column. And then purchase price. Well, they were willing to sell it to us for $6 per unit. So 6 times 10,000 gets us that 60,000. So your total annual cost if you were to buy it would be 90,000. So let's take a look at the effect on net income. So if we were to buy the product instead of make it, our net income based just on variable manufacturing costs would increase by 50,000 because we went from 50,000 as a cost down to 0. So our cost went down, so our net income would have gone up in that singular line. Fixed manufacturing costs, there were no difference, right? We are spending 30,000 no matter what. Purchase price, well, we had more costs if we were to buy it, right? So that would decrease your net income. So overall, there would be a decrease in your net income of $10,000. So, the next part of the question was, should they make or buy? Well, there's a few different ways that we can look at this. We can just look at the total annual cost. If we were to make the product, that would be 80,000. If we were to buy, that would be 90,000. We want a lower cost, right? So we want to make the product. Another way that we can look at this is if we were to buy the product, our net income would decrease by 10,000. So, either way, we need to make instead of buy. Now, question number 5 says, Swift Oil Company is considering investing in a new oil well. It's expected that the oil well will increase annual revenues by 130,000 and increase annual expenses by 70,000 including depreciation. The oil well will cost $490,000 and will have a salvage value of $10,000 at the end of its 10-year useful life. So we need to calculate the annual rate of return. So, your annual rate of return is your expected annual net income divided by your average investment. Now, they didn't come out and give us either of those pieces, but they gave us the pieces to calculate each of those. So first, your expected annual net income. Well, they said that it would increase revenues by 130, but also increase expenses by 70. So our expected annual net income is 60,000. Average investment, we take the cost plus salvage and divide by 2. So the cost is 490 plus the 10,000 salvage value. Divide that by 2 and your average investment is 250,000. So now we have the pieces, right? Now we can plug those pieces into our annual rate of return. So your annual rate of return will be 60,000 divided by 250,000, or 24%. So the annual rate of return on this new oil well is 24%. So now our last question here. Question number 6. Says Johnson Construction is considering 3 new projects, each requiring an equipment investment of $22,000. Each project will last for 3 years and produce the following net annual cash flows. So we have a chart there showing how much cash we're getting each year based off of Project A, Project B, and Project C. It says the equipment's salvage value is 0, and the company uses straight-line depreciation. Johnson Construction will not accept any project with a cash payback period over 2 years. So we need to figure out each project's cash payback period and then indicate which project is the most desirable and which is the least desirable. So the cash payback period is how long does it take before the cash flows pay us back for our initial investment. Right? So we are spending $22,000 on this equipment. How long will it take for Project A to get us back to $22,000? Right? So that's what we're going to do for each individual project. So we have a table over on the left just for Project A. You see the net annual cash flows, but then you also see the cumulative cash flows. Right? So after year 1 is just $7,000. After year 2, well, we made an additional $9,000 in year 2. So far we've made $16,000. After year 3, we will have made a total of $28,000. So that's going to help us as we are figuring out our cash payback period. So we can notice that the $22,000 is somewhere between the end of year 2 and the end of year 3. Right? It's somewhere in between there. So what we are going to do is we're going to take the $22,000 and we subtract out the $16,000. What this shows us is that we need to make $6,000 in year 3 to get us up to that initial cost of the equipment. So once we make $6,000 in that 3rd year, we will have gotten our money back for the investment. So what we can then do is take that $6,000 that we found and divide it by the $12,000. The $12,000 is the year 3 cash flows. Right? In year 3, we made $12,000. So we're trying to figure out at what point in year 3 did we make that $6,000 that we needed. Well, 6,000 divided by 12,000, that's just 0.5. Right? So halfway through year 3, we made that $6,000. So your cash payback period for Project A is 2.5 years. Because it's going to take all of year 1, all of year 2, and half of year 3 to make back that $22,000. So now we can do this for Project B and C as well. So Project B, we're making $10,000 every year, right? So we can see that $22,000 is once again going to happen at some point between the end of year 2 and the end of year 3. So we take $22,000, the cost, and subtract out that $20,000 that we had made through the 2nd year, and we see that we need to make $2,000 in year 3 to get us our money back. So we take that $2,000 and we divide it by year 3's cash flows. and we get 0.2. So 0.2 of the way through our third year, we would have made our money back. So our cash payback period is 2.2 years, right? It's going to take all of year one, all of year two, and 0.2 of year three to get that money back. Now, Project B is a little bit different than Project A and C in the fact that it's equal cash flows. So, if you have equal cash flows like that, you can also just take the cost, the $22,000, and divide it by the $10,000, how much you would make each year. And that would also get us our 2.2. But you can only do that when you have equal cash flows for every single year. So now let's take a look at Project C. So, in Project C, we're going to make our $22,000 somewhere between the end of year one and the end of year two. Right? So we're making it a little bit earlier on here in this third project. So how do we figure out when in year two? Well, we take our cost, our $22,000, and we subtract it by the $13,000 that we had made through year one. And we see that once we make $9,000 in year two, we will have made our $22,000 back. So we take $9,000, divide it by year two's cash flows, that $12,000 amount, and we see that 3/4 of the way through the year, we will have gotten our money back. So our cash payback period is 1.75 years, because it's going to take all of the first year plus 3/4 of the second year. So we now need to figure out which project is the most desirable and which project is the least desirable. So we make a chart like this, right? We have all of our cash flows and our cash payback periods. Well, Project C is the most desirable, right? We want to get our money back. We want to have a cash payback period as small as possible, right? We want to get our money back as quickly as possible. Project C, we get that money within 1.75 years. That's better than the other two. The least desirable, that's the one that's going to take the longest. That's Project A. That's going to take 2.5 years before we see that money back. Now, the problem also said that Johnson Construction will not accept any project with a cash payback period over 2 years. So they would not even think about Project A or Project B. Project C is the only project that Johnson Construction would even consider, because its cash payback period is under that 2-year limit.